Fixed Asset Accounting and Management System. Lookiesoft Fixed Asset Management provides you with the power to eliminate spreadsheets and manual effort from your company's asset management processes. Lookiesoft's complete and integrated solution gives you an easy-to-manage single version of the truth for your assets, a flexible fixed asset calculation engine, complete asset reporting and seamless integration with Lookiesoft's core accounting functionality. Lookiesoft Fixed Asset Management enables you to maintain and control the complete asset life cycle from creation to depreciation, revaluation, and retirement. Its detailed asset management functionality supports multiple depreciation calculation types, handling of depreciating and non-depreciating assets, maintenance schedules, lease, and insurance. Lookiesoft Fixed Assets allows you the flexibility to select which accounting period to depreciate. As an example, with fixed assets seasonal withdrawal and depreciation, you can choose not to depreciate the asset using asset lifetime usage. Instead, you have the option to stop the asset depreciation during downtime. You can assign tax depreciation methods to an asset. These assignments enable tax reporting or corporate reporting methods to be tracked on the asset. Tight integration with Lookiesoft Financials creates accounting entries and fixed assets from purchases to help ensure that no equipment slips through the cracks. Acquire, depreciate, dispose of, transfer and revalue assets. Lookiesoft Fixed Asset Management supports the entire company asset management life cycle, from creating a purchase order within Lookiesoft to tracking, depreciation and eventual retirement. It supports unlimited asset types, whether they are subject to depreciation or are non-depreciating assets that simply need to be tracked. Lookiesoft Fixed Asset Management makes asset creation easy, enabling you to default in types when creating an asset and specify and maintain key fields and details relating to a particular asset. It allows you to manage the complete asset life cycle, completely integrate asset management with accounting, easily report on all fixed assets, eliminate manual effort and multiple spreadsheets, control all transactions related to company assets including asset proposal, creation, depreciation, revaluation, transfer, disposal and split. Easily track depreciating or non-depreciating company assets. Quickly create assets based on unlimited asset types, and report on them. Create assets with the correct quantity and values, allowing users to have multiple proposal records from a transaction with more than one quantity to create multiple assets. Maintain all relevant details for assets, including insurance, lease and maintenance schedules. 1 Key capabilities. Easily track depreciating or non-depreciating company assets. Leverage support for all standard depreciation methods. Create and customize unlimited depreciation methods. Post depreciation and asset retirements directly to Lookiesoft accounts. Comprehensively report across assets, valuation, and depreciation. Asset master data management by department and other segments. Use automated defaults for asset creation, depreciation, and eventual retirement with minimal effort. Track components and depreciate them based on its own depreciable cost and useful lives. Move assets from one location to another or from one subsidiary to another. Increase or decrease asset values through revaluation to reflect its current market value. Account assets expenses for repairs. Comprehensive support for depreciation with Lookiesoft Fixed Asset Management. You gain complete flexibility to depreciate assets based on the right depreciation method. Lookiesoft Fixed Asset Management provides out-of-the-box methods, as well as flexibility that enables you to create your own depreciation methods, even supporting depreciations for both financial and reporting purposes. Leverage built-in support for all standard depreciation methods, including straight line, fixed declining, sum of years digits and asset usage. Create customize user-defined depreciation methods. Use chain depreciation methods to support comprehensive asset valuations. Apply multiple depreciations per asset for reporting depreciations. Computes monthly and daily depreciation. Complete integration with Lookiesoft Accounting. Lookiesoft Fixed Asset Management enables you to easily create fixed assets from purchase orders while ensuring that all asset depreciations and disposals are posted to Lookiesoft's core accounting system. Automate the creation of assets from purchase orders. Post depreciation and asset retirements directly to Lookiesoft accounts. Streamline the entire process, including journal posting, bill posting, and billing posting. Summary and detail real-time asset reporting with Lookiesoft Fixed Asset Management. You can leverage the full power of Lookiesoft dashboards and reports to analyze and report on your company assets in real time. The solution ships with out-of-the-box reports, while giving you the flexibility to build any kind of asset report based on business needs. Comprehensively report across assets, valuation, and depreciation. Slice and dice assets across locations, subsidiaries, asset types, and more. Easily execute pre-configured reports including asset register, register summary, depreciation schedule, and report status. Quickly run pre-built saved searches on monthly depreciation, asset additions, asset disposals, asset list, asset register, proposal history, inspections due, insurance renewals due, expiring leases, and more. Customize report layout to fit business needs. Multi-book accounting for fixed assets management. Lookiesoft Fixed Asset Management lets you assign assets to multiple books and automatically convert asset values to the book-specific base currency where the asset is recorded. Assign different sets of fixed assets general ledger accounts for secondary books. Assign an asset to multiple accounting books that generate book-specific general ledger impact. Run depreciation on any given asset across one or more sets of accounting books where book-specific depreciation journal entries will be generated. Run asset transfers on a per-book basis. Transferred assets will be automatically converted to the book-specific base currency values of the destination subsidiary. Revalue and depreciate assets to one or more sets of accounting books where book-specific journals entries will be generated. 2. What is asset? An asset is an item of value, something that is worth having. Some assets have an expected short life or are readily turned into cash, such as investments or inventory. These are known as current assets. Others have a potential service life longer than 1 year, and are known as non-current assets. Non-current assets may be either a physical item, such as land or buildings, or intangible, such as computer software or intellectual property. The relationship between types of assets is shown below. This guide deals only with non-current, physical assets. Sometimes, such assets are referred to as fixed assets. In accounting terms, fixed assets in this category are defined as physical items of significant value that possess service potential or future economic benefits, are controlled by an entity, and originate as a result of past transactions or events. This definition typically includes such items as land, buildings, infrastructure, plant and equipment, cultural collections, and natural resources. 3 classes of fixed assets. Fixed assets vary considerably in their size and nature, and they should be classified into the following logical groupings for management control, financial treatment, and external reporting. Requirements: land, buildings, infrastructure, plant and equipment, cultural collections, and natural resources. This classification should be used in the chart of accounts for balance sheet reporting in annual financial statements. Classes should be subdivided even further for management purposes. 4. Example, the plant and equipment class of fixed assets should be subdivided as follows. Furniture and fittings. Information technology assets, computing equipment. Office machines. Kitchen equipment, and vehicles. Managers need to distinguish between classes of assets, and exercise judgment and discretion in applying the policies and practices outlined in this part. For example, the maintenance approach adopted for personal computers or a suite of office furniture will be different to that required for a major item of sophisticated machinery or a school. Similarly, the planning input required for the construction of a new resource center would obviously be more comprehensive than that required for the acquisition of a new vehicle. The accounting treatment of various classes of fixed assets may also differ considerably in areas such as applicable depreciation rates, the frequency and precision of revaluation, and the approach to condition assessment and stock taking. In determining the approach most suited to the class of fixed asset, managers should consider their responsibility to account for the effective and efficient management of the item S in question, and the risks and benefits attached to differing levels of record keeping and accountability. For fixed asset management, the principal objective of fixed asset management is to enable an entity to meet its service delivery objectives efficiently and effectively. It involves guiding the acquisition, use, and disposal of assets, and managing the related risks and costs over all phases of the asset life cycle. To be effective, asset management needs to be considered as a comprehensive and multidisciplinary activity that takes into account a range of factors such as the asset life cycle and asset management principles, the needs of the users of the asset, the policy and legislative environment, the entity's corporate management and planning framework, technical adequacy and commercial viability, external or market factors, commercial, technological, environmental, or industry implications, the competing demands of stakeholders, in some instances, and the need to rationalize operations to improve service delivery or to enhance cost effectiveness, in some instances. Managers should use life cycle costing and risk management, as defined in the glossary, to manage fixed assets. Risk management is particularly important as it underpins many of the key decisions made about assets. Asset management is a continuous process covering the whole life of the asset. An entity's asset management program should encompass all the activities illustrated below. Good asset management usually meets the following criteria. The entity knows what is in its asset portfolio, where those assets are and who is responsible for their upkeep. Usually this means that each asset assigned a short asset statement. These are summarized into service asset statements which support the corporate asset management plan. The entity has developed a means of relating the assets in its portfolio to its wider objectives, thus providing a basis for investment and disposal decisions and for setting priorities between them. The asset portfolio is reviewed regularly, on an entity-wide basis, according to criteria set by the Treasury instructions and used consistently across the entity. The entity has considered both long-term, 5 to 10 years, and shorter-term objectives. It links the use of assets to the use of other resources. Decisions about reviews, additions, disposals, maintenance programs and collaboration with other organizations are taken systematically and implementation is monitored by the entity. 5 Asset management principles. 1. Service delivery needs are to guide asset practices and decisions. Entities are to undertake asset management activities within a strategic framework that is driven by program and service delivery needs. 2. Asset planning and management are to be integrated with corporate and business plans, budgetary and reporting processes. Planning, budgeting for, and reporting on assets are to be integrated with broader planning processes, both within entities and between central and other entities. 3. Asset management decisions are to be based on evaluations of alternatives that take into account full life cycle costs, benefits, and risks of assets. Capital expenditure decisions are to be based on rigorous and documented economic appraisals of options that include financial as well as non-financial parameters. The economic appraisals should be evaluated by a party other than the proponent of the project. 4. Ownership, control, accountability, and reporting requirements for assets are to be established, clearly communicated, and implemented. Ownership and control of all assets are to be fully defined. Accountability and reporting requirements for both ownership and control are to be determined and clearly communicated. 5. Asset management activities are to be undertaken within an integrated corporate asset management policy framework. An entity's asset management is to be based on better practice in corporate and industry and on corporate policy. 6. Fixed asset policies. Asset policies extend beyond accounting policies and should be comprehensive, covering all phases of the asset life cycle, and should address the principles of asset management. The development and promulgation of comprehensive asset policies and procedures are important elements of the internal control structure of an entity. They reflect management's operating philosophy and style. Their content is one indication of management concern with maintaining adequate control over its resources. Good policy and procedure manuals are integrated, policy statements and procedural guidance are combined. Consolidated, all relevant policy and procedures are located in one source. Cross-referenced, references to legislative requirements, corporate policy pronouncements, and supplementary instructions are supplied, and formatted for ease of update, preferably in electronic format. Asset policy and procedure manuals should include more than operational aspects, such as recording assets, taking stock, and write-off procedures. They should also address strategic issues, such as planning for acquisition, accountability arrangements, maintenance, and operating policies and strategies. The following checklist has been developed to provide guidelines of the contents of a comprehensive policy and procedure manual. 7. Asset information requirements. Comprehensive, accurate and up-to-date information on assets is vital to effective asset planning. Good information is necessary to support sound decisions about assets relating to service delivery capacity, acquisition, maintenance and disposal, and comply with statutory financial reporting obligations. Information generated about assets must match the decision-making purpose, see below, for which it is required. Strategic decisions, these generally require small amounts of information about a range of issues and asset characteristics related to trends, rather than specific data about individual assets. In this situation, the level of accuracy is of less importance than completeness. Approximations or proxy information are often acceptable for these decision-making purposes. Tactical decisions, these require a broader range of information, and at a greater level of detail. The level of accuracy of the data required depends on the criticality of the decisions to be made. Operational decisions, these tend to require source data with high levels of accuracy as the information supports day-to-day decisions by individual staff in the field. Operational data are the prime sources of aggregated information for tactical and strategic purposes. 7.1 Fixed Asset Register. Entities should maintain fixed asset registers to facilitate the implementation of appropriate portfolio and risk management strategies across the public sector. For a fixed asset register to fully support effective decision-making about asset utilization, it must be comprehensive, and include all assets under the control of the entity. Be structured in a way that allows different classifications of assets to be distinguished and treated appropriately. For example, assets such as buildings and plant may have a Long life and complex maintenance requirements. These may be recorded in a specialized section of the asset register which contains more information than the section used to record furniture and office equipment. Capture details of all transactions affecting the assets, as they occur. Have associated procedures, controls, and audit trails to maintain the integrity of the information. Identify the individual or organizational unit accountable for the asset and the location of the asset, and carry the financial information needed for financial reporting. Information in the fixed asset register must be readily accessible to individuals who are accountable for the control and management of a nominated asset or group of assets, preferably on a real-time basis. Entities may elect to use separate fixed asset registers for different classes or categories of assets. If this course is taken, common data standards should be employed so that consistent, consolidated reports on assets can be readily prepared for the entity as a whole. Appendix 3 lists 3 questions all public sector entities should address to ensure an appropriate fixed asset register is established and maintained. 7.2 Fixed Asset Performance Data. Fixed asset registers should have provision for recording performance data for individual assets. As examples, useful performance data may include measures of the operational performance of the asset in relation to its service delivery. Objectives. Measures of how intensively the asset is utilized, to disclose any surplus capacity that could be taken up for other purposes, and operating costs, to include, for example, cleaning and energy costs and maintenance. Expenditure. The information should be appraised by entities against other entities and/or best practice data to establish whether assets are being managed effectively. 8. Capture of fixed asset information. Fixed asset data should be kept up to date. Data on transactions affecting fixed assets should be captured as the transactions occur, and entered in the fixed asset register. Wherever possible, data transfers should take place electronically, and not rely on discretionary actions or anecdotal evidence. 8.1 Asset data at acquisition. Records for newly acquired assets should be captured from the purchasing system at the time of purchase or acquisition, and the initial valuation of the asset should be taken as the cost of acquisition. In this context, cost of acquisition means the actual purchase price, plus any costs incidental to the acquisition. All costs attributable to the purchase or construction activity should be capitalized and included in the acquisition cost. This includes such costs as design fees, agent's commission, the cost of import licenses, freight, and the like. 8.2 Expenditure on existing fixed assets. Expenditure on existing fixed assets that increases its service potential should be treated as capital expenditure, and must be recorded either as an addition to the value of the existing asset, or a new asset, linked to the existing asset. Normal maintenance expenditure is recorded as an operating expense. Maintenance work should be initiated by a work order or equivalent, and used to collect the costs and to prepare a history record of work completed. The fixed asset register or a specialized maintenance management system may be used for the purpose. Maintenance history is important for forward maintenance planning and budgeting purposes, and care should be exercised to identify and retain appropriate data. 8.3 Stock taking. Stock takes of fixed assets must be carried out at periodic intervals, normally annually, with the results being reconciled with the records in the asset register. The stock take frequency may be modified or supplemented by a sampling approach at the discretion of the entity controlling the assets. QR coding, or similar optical recognition techniques, may be utilized for stock taking purposes to introduce higher levels of accuracy and to reduce asset management costs. 9. Acquisition of assets. The acquisition of assets is a significant asset management activity. Therefore, it is imperative that acquisition decisions are taken within an integrated planning framework that takes account of service delivery needs, corporate objectives, financial and budgetary constraints, and the corporate's overall resource allocation objectives. Options for acquiring assets include purpose design and construction, purchasing or financial leasing. As part of the acquisition process, an entity needs to consider the nature of the assets to be acquired, whether they are specialized assets or general items, the market conditions and the implications for the acquisition cost, the industry capacity based on the number of potential contractors or suppliers, based both locally and overseas, capable of supplying the assets, the industry standard as to how the fixed assets are normally procured in the industry, and the suitability of contractors or suppliers depending on whether the contractors or suppliers engaged need corporate endorsement of the Corporate of Samoa Tenders Board. 9.1 Minimizing the exposure to risk. Acquisition decisions require thorough examination and economic appraisal. Any potential risks, as well as the consequences of acquiring an asset, should be examined before any action is taken. The involvement of the private sector in the acquisition process should also be considered, where appropriate. In accounting for private involvement in public investment, however, the entity should arrange for an appropriate sharing of risk. This approach is consistent with the corporate's drive towards a more commercial focus in the management of its entities. Legal expertise should be engaged to assist in preparing contracts to minimize exposure to risk. Some of the issues which may be applicable and need to be considered and clarified in contracts with contractors and suppliers include the type of contract, ownership and control, performance criteria to be met, rights over the intellectual property developed as a result of the contract, responsibility for maintenance, responsibility for testing, inspection, and installation, and responsibility for post-completion testing. 9.2 Purchasing ethics and principles. Officers involved in purchasing and supply management in the public sector should maintain the highest ethical standards, and seek best value for money. The following principles should be observed. Public money should be spent efficiently and effectively, and in accordance with corporate statutes, regulations, and policies, including the supply policies of the Purchasing Board and the minister responsible for building and construction matters. Confidentiality is to be maintained at all times. Gifts or favors from current or potential contractors or suppliers that might compromise their integrity as a delivery/purchasing agent should not be accepted. Purchasing should be carried out without favor or prejudice. Purchase orders for identical goods or services must not be split in order to circumvent established procurement delegation limits. All potential contractors and suppliers are to be provided with adequate and identical information on which to base their tender, proposal, or quotation. Procedures should be established and maintained to ensure that a. Fair and equal consideration is given to each tender or quotation received, and b. Selection is based on fitness for purpose and on the lowest total cost complying bid. 10. Fixed asset recording. 10.1 Responsibilities. Within entities, accountability for assets will normally be devolved to the business units responsible for the delivery of the service that the asset supports. Fixed asset details should be captured and reported at this level. Individual managers may then monitor and manage the utilization and maintenance of the assets assigned to their control. Details of individual assets must be capable of being consolidated and summarized for financial reporting purposes, and for coordinated portfolio management. If more than one asset register is used within an entity, common data standards should be employed to assist in consolidating the data. 10.2 Recording threshold. Entities are required to set a minimum monetary threshold for the recording and financial reporting of assets. Effort on these activities is then limited to those assets whose value is of significance to service delivery objectives and is above the threshold. This approach can achieve significant administrative savings. The principal consideration in setting a threshold is whether the omission of those assets whose value is below the threshold would materially affect the quality and usefulness of the information derived. In the absence of a conscious decision to the contrary, entities must maintain an asset register for all non-current physical assets that have a value above an appropriate threshold. Ministries are required by TSY instructions to register all non-consumables over $1. Public bodies have their own fixed accounting policies but generally register items of $100 and over. Entities may elect to use a higher threshold to meet their individual requirements, but must be prepared to justify their decision. 10.3 Portable and/or attractive assets. Some items whose value falls below the threshold level but which otherwise qualify as significant assets should be recorded and tracked either for control or security reasons, or to meet other management requirements. Such items may be classified as portable and/or attractive. They should be recorded in the asset register but excluded from the entity's annual financial statements. This exclusion does not mean that they are less important to the entity, but only that full accounting treatment is not warranted. 10.4 Core and non-core assets. The terms core assets and non-core assets are used to distinguish assets that are central to the obligations of corporate from those that are not. An asset is classified as core where it is necessary for the ongoing delivery of a service required by corporate and publicly owned, and not readily replaced with a private sector alternative, or retained for heritage or conservation reasons. An asset is classified as non-core or surplus where it is intended not to be replaced if lost because it is not required for the long-term service output of the entity, or identified as surplus and awaiting disposal or redeployment. 10.5 Grouping of assets. Recording of assets should generally be on an asset-by-asset basis. In some cases, however, it may be more appropriate to record a group of interrelated assets, of which some or all of the components may have a value below the recording threshold. Examples include a major piece of machinery with a number of sub-assemblies, or an infrastructure asset such as a services network. The fixed asset register should record the grouped asset, and identify the individual components. Unlike assets that are aggregated for convenience, a group of assets attracts particular value because it represents a complete collection, e.g. a suite of furniture, a set of crockery, or a services network. Loss or removal of one item would significantly diminish the value of the group or collection by making it incomplete. This would apply even if the value of the particular item were relatively low. This contrasts with an aggregation of assets where the loss or removal of one item may have negligible effect on the total value of the aggregated assets. 10.6 Aggregation of assets. Some entities have large numbers of homogeneous assets which have complementary values, such as library books, or a collection of scientific material. In such cases, the assets may be recorded in aggregate. As for assets that are grouped, this approach will be useful where the value of the components of an individual asset may fall under the recording threshold, but the aggregate value of the asset is above the threshold. Aggregation should not be used for assets that have fundamentally different characteristics, as this will result in inconsistent assumptions about useful life and depreciation. 11 Asset valuation and depreciation. The valuation of assets is undertaken for a number of purposes. For example, the valuation of an asset may be used to generate the information needed for internal control, resource allocation and performance assessment. Establish the basis for asset realization. Determine insurance cover and risk exposure, and meet requirements for external financial reporting. Choice of an appropriate valuation method depends firstly on the purpose of the valuation, and secondly on the nature of the asset involved. The initial valuation is applied at the time of acquisition, and generally corresponds to the cost of acquisition. Subsequent revaluations are undertaken at periodic intervals with a frequency chosen to reflect the nature of the class of assets concerned. Valuation methods used should be in accordance with the accounting standard property, plant and equipment. A description of the approach to be taken to depreciation is discussed below. 11.1 Valuation of core and non-core assets. It is necessary to distinguish between core and non-core assets in determining valuations. A non-core asset is to be valued at its net realizable value, which is the current market value net of all costs involved with disposing or redeploying the asset. A core asset should, in general, be valued at the cost of replacing the service potential remaining in the asset. If a viable market exists for the asset, a core asset is to be valued at its current market price. If a market for the asset does not exist, a core asset is to be valued at its written down replacement cost. 11.2 Valuation of heritage/cultural assets. True valuation may be difficult to obtain for assets retained for heritage or conservation purposes. Heritage assets have two components of value, a market-related value and an aesthetic or social value. The aesthetic or social component will probably not be reflected, in part or in full, in the asset's current market value. A note to the entity's annual financial statements should mention that the asset's true worth to the corporate is probably only partly reflected in its reported value. If an entity has difficulty in establishing a reliable measure of a heritage or cultural asset's value, it must notify the Treasury. Insurance and risk management issues must be considered. Entities must also provide narrative information in the notes to their financial statements on heritage assets. 11.3 Depreciation. Depreciation recognizes the cost of consuming the service potential of an asset over time, and provides a means of accounting for the cost of an asset over its useful life. The recognition of depreciation charges is necessary for the valuation of assets and costing of services, and is also used for resource allocation and asset performance assessment. Depreciation is not normally funded and does not provide cash for the replacement of an asset. Depreciation can be calculated in several ways. Some methods are arithmetical, such as the straight line or reducing balance techniques. Others are designed to reflect the actual condition or capacity of the asset as realized over time, such as the production unit method, or condition-based depreciation. The method chosen should match the pattern of service potential yielded by the asset as closely as possible, and the depreciation charge will then be a realistic reflection of the cost of providing the services by using the asset. Depreciation rates must be reviewed annually and, if necessary, adjusted to reflect the most recent assessments of the asset's useful life. See the section on useful life below for issues to be considered in making this assessment. 11.4 Asset useful life. An asset's useful life is the period over which it is expected to provide the entity with service. Depending on the nature of the asset, useful life can be expressed in terms of time, years, or output, production or service units. Useful life must be realistically assessed. Entities should consider the following. Over what period does the entity expect to gain service potential from the asset? Has the asset been acquired for a specific project, or can it be redeployed within the entity over time? What has been the past experience of such assets in use? Is the past experience an appropriate benchmark, given the technology embodied in The asset. Has an independent advisor assessed the condition of the asset or its life expectancy? What is the opinion of the user or relevant expert about the asset's useful life? What is the net amount expected to be recovered on the asset's disposal? Consideration of these factors will enable the expected life of an asset to be assessed realistically. Useful life is an important determinant of the rate of depreciation. 12. Fixed asset maintenance. Entities should be responsible for developing at least a 5-year asset management strategy for the assets under their control. The strategies are to cover maintenance, refurbishment and energy management and include all operating costs. They should also detail the systems and processes to be established to monitor asset performance. The usefulness of an asset depends on how effectively it meets its purpose. For many types of asset, this may depend on the regularity and appropriateness of its maintenance. Regular maintenance may also help to preserve an asset's value. Planning for asset maintenance enables targeted action to be taken in a timely and cost-effective manner. This, in turn, helps to ensure that the entity's asset portfolio can remain appropriate and productive for the lowest possible long-term cost. As a first step, the entity must determine which of its fixed assets need to be maintained, i.e. it must assess the materiality of its assets. Some fixed assets may, for example, have low or little value and have a relatively short expected life. Others may be of a type that normally requires little or no regular maintenance effort, e.g. furniture. Entities controlling such assets may elect to exclude these from the formal maintenance planning process, and rely on regular condition assessments or inspections, e.g. in conjunction with stocktakes. For each of those assets or groups of assets that are to be regularly maintained, the entity should develop a maintenance strategy. 12.1 Maintenance Strategy. A maintenance strategy is a comprehensive plan that defines the asset, the performance required of it, and the level to which it is to be maintained. Describes the systems and procedures to be used to plan and manage the maintenance work. Specifies the types of maintenance to be carried out, and why. Nominates the means of resourcing and implementing maintenance. Indicates any requirements for in-house plant, equipment, or spare parts, and outlines the projected costs of routine, and corrective/preventive, maintenance, as well as forecasting major replacements for the next 5 to 10 years. In developing a maintenance strategy, 2 considerations are particularly important: the level of maintenance required for the fixed asset and maintenance priorities. 12.2 Level of maintenance. The level of maintenance required for an asset, and the performance expected of it, should be clearly established. The level set should be consistent with the role that the asset will play in the delivery of services, relative to other like assets in the portfolio of the entity. Reflect obligations for compliance with statutory requirements for occupational health and safety, fire, environmental management, and the like. Be realistically attainable, given the age, condition, and expected life of the asset. Be capable of being achieved within planned resource availability, and be agreed with the users of the asset. The level of maintenance should specify the extent to which the performance of the asset is operationally critical and to which visual appearance is important. It should also stipulate the necessary response times in the event of failure. Maintenance priorities. Higher priority maintenance tasks, such as those that affect health and safety or that are operationally critical, should be identified in the maintenance strategy. This will enable maintenance effort to be focused on these areas if resources fall below the planned levels. 12.3 Maintenance Plan. Once a maintenance strategy is developed for an asset, it must be translated into annual maintenance plans that set out, in detail, the maintenance tasks to be performed each year. The maintenance plan provides a basis for managing the work and for monitoring maintenance performance. It should set out the maintenance requirements of assets, broken down into individual components, systems, or elements when necessary. It should also include a statement of resources, which details such information as the resources required to undertake the maintenance function, including its planning and management, the expected number and type of maintenance contracts and suppliers, and the expected funds sources for both capital and recurrent costs over the period. Sources of funds could include recoveries from user charges and other sources as well as funds appropriated in the budget. Maintenance data need to be captured as work is performed, with records being kept of maintenance history for planning purposes. As appropriate, such data should also be used to prepare the annual maintenance plan. 12.4 Criteria for assessing maintenance performance. The outcomes of effective asset maintenance include a long-term reduction in life cycle costs, better asset performance and service, the optimization of asset life, and improved public perception of the asset's service and safety standards. These outcomes should be monitored and reported through the use of performance measures. Typical indicators can be derived from such measures as the asset's availability, its operational performance in relation to service delivery, its energy consumption, its operating costs, and user satisfaction. Many of these indicators can be benchmarked against other like fixed assets. 13. Asset disposal. Entities should evaluate the effectiveness of their redeployment/disposal strategies in maintaining an asset portfolio that best meets service needs, and establish arrangements for the decommissioning of assets and for underperforming or surplus assets as efficiently as possible, prior to redeployment or disposal. Asset disposal decisions are to be made within an integrated service and financial planning framework. The following guidelines are provided to help entities dispose of their assets in an accountable manner. Entities should establish and maintain an asset information system, which records all relevant information, to assist in asset planning and management. Prepare and evaluate proper costing to support the selection of the most cost-effective disposal methods. Identify those areas most susceptible to fraud or risks, and introduce appropriate preventive measures. Identify and communicate the preferred arrangements for disposals to relevant staff. Engage experts to develop the terms of contract and to assist in preparing the contract, particularly for complex and non-standard disposals, to minimize the exposure to risk. Provide clear instructions to the agent engaged to undertake the disposal, and monitor and evaluate disposal performance regularly for achievement, fair dealing, cost-effective choice of disposal methods, and for compliance with the corporate's disposal policies and objectives. Different disposal methods will be needed for different types of assets. Auctions, for example, may not be appropriate to dispose of some classes of assets. Before deciding on a particular disposal method, the following matters should be considered: the nature of the asset, i.e. a specialized asset or a common item; its potential market value; other intrinsic value of the asset, i.e. cultural/heritage aspects, etc.; its location, with respect to its transportation or access; its volume; its trade-in value; its ability to support wider corporate programs; environmental considerations; market conditions, and the asset's life. Appropriate means of disposal may include public auction, public tender, transfer to another entity, sale to another entity, sale to staff, trade-in, and controlled dumping, for items that have a low value or are unhygienic. As discussed earlier, professional valuations play an important role in asset disposal. They can help managers to select the most appropriate selling method. They also help to set realistic expectations for the sale. If they are required, valuations must be obtained from experienced agents who have knowledge of the type of asset, for sale and the current market trends. The Ministry of Natural Resources and Environment, MNRE, employs a valuer who is supposedly responsible for all corporate valuations. Fixed Asset Accounting and Management System Modules. Administrator. User Properties. User Logs. App License. Master Data. Corporate. Vendor. Asset Data. Asset Type. Asset Group. Chart of Account. Currency. Taxes. Cost Center. Numbering. Unit of measure. Country. City district. Transactions. Asset data. Asset movement. Asset disposal. Asset on aim. Asset takeout. Asset return in. Maintenance. Main plan. Main progress. Main closing. Reports. Asset data. Asset movement. Asset disposal. Asset on aim. Asset valuation. Asset history. Asset takeout. Asset return. Asset QR code. Messaging. Inbox. Outbox. Draft. Your account. Change password. Change photo. Change language. Log history. Lookiesoft Web-Based Software as Services. We offer web-based software as services, SaaS, for your business solution. Lookiesoft, the software engineering services, believes, practices of the software engineering principles and best practices. Our adopted process framework, and our conviction on quality based our own software development experience, enables us to deliver the best to our customers. While software engineering has been around for decades, its adoption leading to business success through improved quality and predictability has been, by and large, a mirage. Software is essentially a construction in mind and, a collective one at that, with many stakeholders of varying interests and skills. Applying the engineering principles is more of continuous refinements of an adaptive process rather than adoption of a prescriptive process. Lookiesoft, with its wealth of acquired knowledge and more than a decade of experience, has specialized in transitioning itself and its customers into sound software engineering practices without undue documentation and technology overheads. We are the only IT consultancy management, design and development, software as services, SaaS, and cloud application solutions. SaaS application on desktop computer. SaaS web-based application will be installed on standalone desktop computer. SaaS application on VPS server. SaaS web-based application will be installed on data center VPS server. SaaS application on _colocation or own dedicated server. SaaS web-based application will be installed on data center with colocation or own dedicated server. SaaS application in-house server. SaaS web-based application will be installed on your in-house server. Professional business application service provider. Software as service, SaaS, provider. Software as a service, SaaS, is a software distribution model in which a third-party provider hosts applications and makes them available to customers over the Internet. SaaS is one of three main categories of cloud computing, alongside infrastructure as a service, IaaS, and platform as a service, PaaS. VPS and dedicated application services. We also offer customers to run our web-based applications with a VPS that runs its own copy of an operating system, and customers may have super user level access to that operating system instance, so they can install multiple applications that runs on that OS. The system working 24 hours with high bandwidth internet connection. Agile software development. Agile software development is a conceptual framework for software engineering that promotes development iterations throughout the life cycle of the project. Website development. Our expert team of website developers and digital strategists use cutting-edge technology and best practices to create custom sites that increase user engagement. We understand that every custom web development project is unique. We want to get to know your brand, understand your needs, and determine an appropriate timeline and project plan tailored to your business. Anwar. Founder, creator and developer. Email, nokaisoft@gmail.com